Hi, everybody. This is Gary Dean, and this is our Nightly Vid Report for Wednesday, January 20th, 2016. So, pretty big roller coaster we had today. I took my second half of my SSO, and what I was thinking with moving over to that instead of the options today at least proved right because I was pretty underwater with the first half of the SSO, and from my entry today, I'm up $100, and I have a feeling that if they were options, I'd probably still be down close to $1,000. So it's one of the reasons why I made the move. So let's get started. There was a complete panic today. The S&P made it to support zones that were made all the way back in 2014, and this was the reason why I took my buy here. This is a pretty bullish candle. We've seen some pretty good rallies off of these types of candles where we're down a lot and then close not that bad, even though the S&P was down 22. If we just kind of go back into this, this is the October of 2015. If you look at it, what happened was we had a nice big rally off of this support here, but then if I remove this, we came back down the next day and then eventually made a big move up. I'm not anticipating this type of move up like this, and again, the trade that I'm in right now is for a trade, and I would not be surprised to see the S&P trading back up to anywhere between the 1990, and I would not rule out the 2030. Yes, it is a ways up. It may be different than what some people are looking at, and this is just from a technical basis. Typically, when we make these big moves down and we move away from the moving averages, we at least come back and give them a test again. We just got the cross right here, so a test of these moving averages would not be out of the question. So it seems like it's crazy talk right now because we're talking that the first moving average is all the way up at 2030 and the S&P is at 1860. I'm just saying if it gets up there, it would make sense. Am I going to hold on to these trades up here? I don't know, but with just owning the SSOs, I can just place stops in place. It's a lot easier because than the options, you have one bad day where you're thinking it could go higher, and your options could lose 30% in a day. You're not going to get that with the SSO, and that's kind of the reason why I switched. So what I'm saying is this: I'm in for a trade right now. If the bulls can push through some of this resistance level, next spot's going to be the 1950. From there, it's going to be the 1990, and then again, I'm leaving the door open for a bounce to come all the way here, even though I'm not saying that is exactly what is going to be happening. What may actually be more sense is that because if we look at this, just look at it as a wave count. We have 1, 2. Now we have your 1, 2, 3. So we may get a bounce right now that comes back up to this 1940, 50 area, and then come down and make lows again, where now it will set up bullish divergences on the daily chart, and then from there we get a bigger rally that may take place later on in the year. But right now, if we get a move up to the 1950, I'm just going to place a stop on the SSO. If it decides it's going to run higher, hey, great, my stop will be in place and I'll just keep running it. If the bulls lose this in the coming weeks or so, that's where I believe we're going to see the 1740 come into play, but I still think that we get a bounce before we come down there. 60-minute chart. Reason why I took my second position is we still, even with the big drop today, had bullish divergences in place. Here's the trend line the bulls need to get through. It's sitting, let's just call it the 1898. If they pop through that, then I believe that we see the move come to the 1930, 1950 area. If they get through that, then we could come up to the moving average here. So first thing on the plate for the bulls, I would say, is to get through to 1900. If they do that, then we could start eyeing some of these levels here. But again, we have bullish divergences even with a drastically down day at today, and it's one of the reasons why I took it. Plenty of room on our momentum to move higher. If I take a look at the 15-minute, I never erase these. Sorry, this is obviously not in play. But anyway, here is the shorter-term resistance. And you can see that the S&P did try to break through it. Towards the end of the day, we got some people that, were selling, but this was really the first attempt at the short term, and it made it up to the 23% retracement. So if they head down, again, 23% retracements are typical of wave 4s. If they hold it, then, again, the next spot, 1915 to 1947, would be what I would anticipate the next move to go to. And I still believe that, pushing the short side down at these levels with bullish divergences on 60-minute and on the 15-minute after a big drop at support, I just think it's asking for trouble. I've been wrong. I'll be the first one to admit to it, but it's still not something I would be comfortable shorting. So anyway, let's move to where the bulls now have to hold. They're at one support level right now. If they lose that, then you really want to keep an eye on the 1850 again, but more really, I would say the big line in the sand is going to be the 1840 and the 1836. If they lose that, most likely this was just some kind of wave 4, and we're going to take out these lows or at least test them again. So right now, I still think it's dangerous to short. I think that there's a decent rally pending. I would not be surprised to see that rally come somewhere up into the 1947, 1978 area, and I would not count out a move coming close to the close to these levels here, even though I'm not guaranteeing that. It just would make sense from a technical aspect. So with that, have a great night, and I'll talk to you guys tomorrow.